Okay, let's start. Welcome to the last and final TRG. Um, so I believe that in the first three classes, I went through as many questions as I could from different areas of the syllabus. And like I said, only if I, do that, if I directly jump into the questions and then talk about theory, that's the only chance we have of covering as much areas as possible. Okay, because if I was to go through the theory again and again, then that is basically talking about another lecture session itself, which we will need 6 months for, which we don't have, right? So that is why we jump straight in the questions. So TRG 1, 2, and 3, we focused mainly on constructed response questions, like the one I have displayed here. Okay, it will be worth 20 marks. That's what we focused on. The reason is, if you can do a constructed response question, bits and pieces of this question is what you will see in an MCQ or an MTQ style question. Okay, this is basically, it has everything involved. So if you can do constructed response and if you're comfortable with it, then you shouldn't have many problems with an MCQ. So that is the reason why we chose constructed response. So from these constructed response questions, I did as many as I could from working capital management. I did risk management. I did investment appraisal. We did business valuations as well as sources of finance and cost of capital. So one last constructed response question I'll be doing is this DISCA company. It will be from investment appraisal. The reason why I'm doing this is there is a particular adjustment in the NPV calculation that we haven't really seen in any of the past questions. And although NPV is easy, it is very, the probability of it being examined is very high. So I don't want to leave that untouched. So I will do that as well. First thing. Next thing is, like I said, we have always focused on constructed response. And I think we did one MTQ. If you remember, we did a company called Bill Company. That was the only MTQ. So after I'm done with this constructed response, I will go through a few MCQ style questions and I will show you how to handle them. Because end of the day, 60 marks, 60% of your paper is going to be based not on constructed response. It's going to be based on MCQs. Okay, so it is definitely easier than constructed response, but if you don't know the proper technique, you might waste time there. Okay, so I just want to go through a few MCQs. Finally, there is a pre-mock. Okay, so there is something called a pre-mock that is released by ACCA for the March 2024 session. Okay, for the March 2024 session, there is something called a pre-mock that they have released. You will be able to find it in your ACCA study hub, basically. Okay, so if you go to the study hub, or if you don't know how to navigate the study hub, then simply type ACCA pre-mock FM March 2024. It will direct you to that page. Okay, so you can just type ACCA FM pre-mock and you will be able to get the page. So for you to access this pre-mock, you definitely need a ACCA registration number, an ID, as well as a password. Only then you will gain access to it. But please make it mandatory, make it compulsory that you time yourself. Okay, so give yourself 3 hours, do this pre-mock, and the answers to the pre-mock is also available in the study hub itself, or in the practice platform rather. So it is available in the practice platform. Please make sure that you mark it and grade your score. Okay, so before your exam, make sure you time it and then you mark it using the marking scheme that they have provided, and see where you stand, see what are the areas that you need to work on. Finally, they also have a debrief video. Okay, a debrief video where there is an basically a lecturer. She will explain the most important areas of the pre-mock and how to answer those questions. Okay, so the debrief video honestly is the main reason why I have left this to you, because I know even if you have a problem, you will be able to solve it with the debrief video. Okay, so if you have done everything, you are comfortable with all areas, which you should be at this point, then it's a good idea to try the pre-mock out. Reason is, this is released just before the March 2024 session. So obviously, the actual exam that you're going to get, there will be some sort of resemblance. Okay, if not, they won't just, for no reason release something. No, so there will be some. I'm not saying it will be 100% copy. Obviously, it won't, but there will be some resemblance. Okay, so make it a point to do this. All right. Okay, so having said that, let's jump straight into what we have for the day. So let me read this. This is a question from December 2016. Reason why I chose this paper is because when I saw the pre-mock, it kind of resembled the December 2016 session. Okay, the questions that were there, the constructed response, all of them, it kind of resembled this session. So that is why I picked this paper to do. Okay. Right. So we have a Disca company. Let's see what it says. It's saying Disca is looking to expand the capacity of an existing factory in its alpha division by 850,000 units per year in order to meet increased demand for one of its products. So what they're trying to say is we have a division, alpha division. Maybe we are producing 500,000 units right now. We want to increase it by 850,000 units because there is demand for this product. Okay. Now, for us to do this expansion, it will cost 3.2 million. So that is the investment. Then it says the selling price of the product is 3.1 per unit and variable cost of production are 1.1 per unit, both in current price terms. That means in year naught, the selling price is 3.1 and the variable cost of production is 1.1. That is year naught. Okay. Selling price inflation of 3% per year and variable cost inflation of 6% per year are expected. So this 3.1, it will inflate by 3% every year, and the 1.1 is going to inflate by 6% every year. That's what they're saying. Nominal fixed cost of production have been forecast as follows. So we have fixed costs as well. Year 1, 110,000. Year 2, 205, 330, 330. Disca company has a nominal after-tax weighted average cost of capital, a WACC, of 10% and it pays corp tax of 20% per year, 1 year in arrears. That's important. Okay, so it's 1 year in arrears. The company can claim 25% reducing balance tax allowable depreciation. Okay, so reducing balance tax allowable depreciation on the full cost of the expansion, which is on the 3.2 million, which you should assume is paid at the start of the first year of operation. Okay, so this is this 25% tax allowable depreciation. We are assuming that it will, start on the first year of operation. I'll talk about this when doing that adjustment. Disca evaluates all investment projects as though they have a project life of 4 years. Okay, so it's 4 years and assumes 0 scrap value at the end of 4 years. A is asking you, calculate the net present value of the investment project and comment on its financial acceptability. So it's a very simple net present value classic question, 8 marks. If you can do it, if you see this, you should be very happy at your exam. Okay, right. So let's start. First, let's, kind of have a structure for the NPV. Okay, so let's say NPV calculation. Okay, we will have the years. As always, we will have the years. Then we can have year naught, year 1, year 2, year 3, year 4. It is for 4 years, but we will include one more column for year 5. Why are we doing that? Because we are paying tax in arrears. Okay, so we are paying tax in arrears. So that is why we will have to do that. Right. Next, what can we do? The first value that we have to have, okay, the first value that we have to have, obviously, is the selling price information. So we need to have the sales revenue. Okay, so first we have to have the sales revenue. Then we have to deduct it by, we have to deduct the sales revenue by the variable costs. Okay. If you deduct sales revenue by variable cost, you can usually take a total and call it contribution. Okay, we can call it contribution. Then you need to deduct the fixed cost. Okay. After that, there are other tax calculations and so on, which we are not too sure right now. For now, let's figure out the sales revenue, variable cost, and the contribution. Okay. So let's call this working number 1. So let's leave some space here and say sales revenue working 1. So what are they saying here? They are saying currently it is 3.1 per unit, the selling price. Okay, the selling price is 3.1 per unit, but it is going to inflate by 3%. It is going to inflate by 3%. So let's see in year 1 what it will be, year 2 what it will be, year 3 and year 4, because the operations are for 4 years. Okay. So in year 1, it will be 3.1, which is year naught's figure, multiplied by the inflation rate, which is 3%. So if you want to increase it, it will be multiplied by 1.03. Okay, 100 plus 3, 103%. That is as a decimal 1.03. So you get the selling price in year 1, it is inflated to 3.193. Okay, so let's just make it to 2 decimal places. Okay, 3.19. Then in year 2, what happens? The 3.1, same year naught figure, but this time we have to inflate it for 2 years. So that will be into 0.3 to the power 2. Okay, so same thing for year 3, 3.1 into 1.03 to the power 3. And here it will be 3.1 into 1.03 to the power 4. Let me just check if everything is correct. 2, 3, 4. Yeah. So let me make all of this 2 decimal places. Okay. So you have selling prices as 3.19, 3.29, 3.39 and 3.49. Okay. So that's the selling price. So now if you want this total sales revenue, you have to multiply this by the number of units that you sell. Okay. So they say here that we are trying to expand the capacity by 850,000 units. Okay. We are trying to increase capacity by 850,000 units. So the sales volume, okay, let's do it in thousands. That will be 850. Okay, 850. Now, if you multiply the 2, you'll get the sales revenue, which is 3.19 multiplied by 850. So that is 2,714. So you can get all your answers. Again, let me make it a whole number. I don't want to deal with decimals. Okay. So this is the sales revenue figure. So we can copy this here. Okay. So let me just let's go with whole numbers. Okay. Right. So now we are done with sales revenue. Let's do working number 2, which is variable cost. Okay. So variable cost, what they tell us is in year naught, okay, if you want, you can just put this figure here. You don't have to include it. It was 3.1. Okay. So here they are saying variable cost in year naught is 1.1. So in year 1, it will inflate by 6%. They're saying variable cost inflation is 6%. So that will be 1.1 multiplied by 1.06. That's for the first year. Then here, you can copy the same thing. I'm just doing it in case somebody has a question. Okay. Here it will be 1.1 into 1.06 to the power 3. And here it's 1.1 into 1.06 to the power 4. Let me make all of this 2 decimal places. Okay, so you have in year 1, it's 1.17, 1.24, 1.31 and 1.39. Those are the variable costs. Now again, the variable cost also, if you multiply it with the sales volume, you should be able to get the total variable cost. So we can call this the variable cost. Sorry. So this one into 850, 991.1. Again, let's make it a whole number. Okay. So there we go. We have all the variable cost as well. So let's copy it and paste it here. Oops. I've copied it with that. Okay. You can reference the cell, but it doesn't make a difference because anyway we have formulated over here. Okay. Right. So we have the sales revenue and the variable cost. Now let's take a contribution, that is this value minus this value. So that is 1723. So for everywhere, for all the years, you can get the contribution year 1, year 2, year 3, year 4. Okay. Right. So now we have the contribution. Then they talk about a fixed cost, which is year 1, 110,000, 205,000, and so on. Okay. So at the beginning itself, one thing I forgot to write here is, let's just say that the question is done in thousands. Okay. If not, we will have huge figures. Right. So fixed cost, we know it over here, 110, then 205, 330, and 330. Okay, so everything is there. Now we can take another total, call it the taxable cash flow. This is called the taxable cash flow. So what is that? It is the contribution minus the fixed cost. Take the totals for all the columns. So that will be 1613. Then we have 1540, then 1436, and 1455. Okay, that's a taxable cash flow. Now, taxable cash flow is the amount that you have to pay your taxes on. Okay, so what was the taxation they're telling us? They're telling us that we pay corporation tax of 20%. That means for this cash flow, these 4 cash flows, you have to pay a corporation tax of 20%. So tax at 20%. Okay, but you have to be careful with the timings. Why? Because we are not paying tax in the same year of the cash flow itself. We are paying it 1 year in arrears. Okay, so this 1613 cash flow, 20% of it is obviously the tax, but we are not going to pay it in year 1. We will be paying it in year 2. So 20% of 1613. Okay, so we will have a figure even for year 5. Okay. Okay, so basically 20% of 1613 is 323. Then 20% of 1540 is 308. And then 20% of 1436 is 287. And 20% of 1455 is 291. All right. So that is the taxation. Now, we have one final adjustment that we have to make, and it is to do with tax allowable depreciation. And this tax allowable depreciation, it usually gives us a tax benefit. So let's do that calculation. We'll call it working 3. So I told you there was one calculation that we didn't get to cover when it came to our TRGs. It is this. Okay. So let me type it over here. Tax benefit. So this is how you will do a tax allowable depreciation calculation if it is a reducing balance basis. So how we start is, we start with year 0. In year 0, we have an investment. Okay, so let me type it here since there is space. There is an investment. How much is that investment? 3.2 million. Since we are doing everything in thousands, we'll call it 3,200. Okay, this is an investment. Now, for this 3,200, they give us a tax allowable depreciation at how many percent? 25% you can claim. So, what is tax allowable depreciation? It is like, basically, it's like this, right? If you have an asset, okay, according to accounting principles, you don't charge the entire price of the asset. We don't put it in the income statement as an expense. We don't do that. What do? We put it as an asset in the balance sheet, and every year we release a small portion of that asset expense in the form of depreciation. But the thing about depreciation is there are different methods to calculate it. It's very easy to manipulate that figure. So, for example, if we want to show a low profit so that we can pay a low tax, then it's very easy for a company to manipulate the depreciation figure because that's an expense and put a huge depreciation figure. The profit will anyway come down, tax will come down. The tax authority knows that that is a loophole. So that is why they say, you know what, we are not going to accept depreciation. Okay, because we know that you can manipulate that figure. We will give you a method to calculate something similar to depreciation. We'll call that a tax allowable depreciation. So we tell you how to calculate it. Based on our rules, you calculate it and get a taxable profit. That's no problem because then we know you can't manipulate. Of course, for the paper FM, it's not important to know the details of this. You just have to know how to do this, this adjustment. That's it. In the F6 paper, the taxation paper, you will definitely learn details of how this tax allowable depreciation works. And actually, this will make a lot more sense if you know the entire system. But don't worry, for now, just the calculation is all that you need. They won't ask you anything more than this. Okay? So 25% of the investment you can claim. So that is 25% of 3,200, which is 800. You can claim it as tax allowable depreciation. Okay, so this is basically like a kind of depreciation. So in the end of the year, so year 1 basically, we call a written down value. That will be 3,200 minus this tax allowable depreciation. Okay. Now what you have to understand is the tax savings, it happens on this tax allowable depreciation figure. Why? Because the tax allowable depreciation is like an expense. If an expense increases or if an expense is created, then for that amount, this 800, it actually reduces the cash flow by that amount. So ultimately, the 800, although it's an additional expense for you, it ends up giving you a tax savings because this is an expense, it reduces profit. Anything that reduces profit, it will give you a tax savings. Okay, so the tax savings happens at this tax allowable depreciation 25%. How much will be the savings? I'll type it here, tax savings. It is 20% because our corp tax rate is 20%. So it will be 20% of this 800. So the tax savings, it will be $160. Okay, so I'll come again. Why are we calculating tax savings on the tax allowable depreciation? Because tax allowable depreciation is an expense. Okay, it's a type of expense. It's like depreciation also. Depreciation also is an expense. Any expense, it will reduce profit. If profit reduces, then the amount of tax that you pay will also reduce by the same amount. Okay, but what you have to understand is this tax allowable depreciation, it's not a real expense. Like you don't go and pay somebody tax allowable depreciation, right? Just like how depreciation for machinery is, you don't go and pay that amount to somebody. It is basically a hypothetical figure. So if that figure is reducing profit by some amount, then automatically you will generate a tax savings on that amount because it has reduced profit by 800. Okay. So that is the logic behind why you get a tax savings. Now, the last thing is you have to figure out the timings of these savings. Now, what you have to understand is this tax allowable depreciation, you calculate it at the end of the year. So, at the end of year naught is almost the same as the beginning of year 1. Okay. So, basically, this tax allowable depreciation, we calculate it for year 1. But what you have to understand is taxes are paid 1 year in arrears. So any tax savings that we calculate for year 1, we will realize that not in year 1, but 1 year later in year 2. Okay. So the timing usually for tax allowable depreciation, if it is 1 year in arrears, then the first savings will happen in year 2. If there was no 1 year arrears, suppose they say we are paying tax in the year that is incurred, then the timing will be year 1 itself. Okay. So you have to do this, you have to do the same thing until year 4. Okay. So year 1 written down value is that much. Then again you have the tax allowable depreciation. 25% reducing balance basis. So that's 25% of 2,400. Okay. Then you will have year 2 written down value, which is going to be 2,400 minus 600. 1,800. And where will the tax savings happen? It will happen with the tax allowable depreciation. So I'll just bring this figure down. Okay, so you can see this will be 20% of B35, which is 600. Okay, and the timing, it will be in year 3, 1 year later. Then again, you will have another tax allowable depreciation. Again, 25% of, now this time it's 1,800, 450. And then we say year 3, the written down value is 1,800 minus 450, which is 1,350. Okay, and this is the figure you use to calculate the tax saving. So you get 20%. I'll just type it in case, 450, 90. That savings will happen in year 4. Okay. Now finally, now we have got until year 3. Now year 4 is the last year. Okay. Now in the last year, remember, sometimes we might have a scrap value. Now in this question, they're saying that we are going to assume a 0 scrap value. So in this case, it's 0. But sometimes you will actually have a figure saying scrap value. You have to put it there. Okay. And then what you do is deduct the year 3 written down value with the scrap value. And if you get a positive answer here, okay, let's say it was a positive figure, something now like here it's 1,350 positive. Then it's called a balancing allowance. Suppose it was a negative figure, then it will be called a balancing charge. If it is negative. Okay, so I'll just put it here. If this was a negative figure, it will be called a balancing charge. So in this case, it's a balancing allowance. Now, on this balancing allowance or charge also, you will have to calculate a tax savings. So that will again be 20% of 1,350, which is 270. You will gain that benefit in year 5, 1 year later. Okay. Now, suppose it was a balancing charge here, then it won't be a tax savings. Then it will obviously be a tax payment, and this will be a negative figure if this was a balancing charge. Okay. Right. So that's all you need to know with regard to how to do the adjustments for tax allowable depreciation. So now let's put in all the figures that we have. Year 2, it's 160. So year 2, it's 160. Then 120 for year 3, 90 for year 4, and 270 for year 5. 120, 90, 270. 70. Okay. So now we have done the adjustment for the tax allowable depreciation as well. Right. Now what we can do is, sometimes it's like this. You can include the investment here as well. If you want, I will include it now. But if you're going to use the spreadsheet, there is something called an NPV function, right, in the spreadsheet. So if you're going to use the NPV function, then it's better to not put year not. You can do the investment separately. So first, let's do it without the function. Later, I'll show you how to do it with the function also. Okay, if you're interested, you can use the function as well. Right. So let's take a total here. We'll call it the after tax cash flow. Okay. So second, cash flow. So this will be the contribution, sorry, the taxable cash flow. Yes. So you can just put 1,613 over here. This will be 1,540 minus whatever tax you're paying plus whatever benefit you're getting. So you can copy this for these two because the functions are the same. And in year 5, you will have 291, which is a negative figure, and 270, which is a positive figure. So overall, this will end up being negative. Okay, so we're talking about, I don't want to put this as negative. So I feel it's better to not formulate this cell, right? Because usually we will have a figure on top. Here, let's just take the difference and put it as it is, okay? So this is a negative 291. This is a positive 270. So what happens is you will have a negative 21 here. 21 is fine. Now you can include the investment as well. The investment, which is 3,200. Okay, the investment is 3,200. Give me a second. Let me see if I can. Yeah. I'll just put the investment a little higher so we can have them all on the same line. Okay, so this will be 3,200, but of course a negative figure, negative 3,200. Now you have all the cash flows. What you have to do is take the discount factor at 10%. Okay, so this is available to you in your exam. Let me show you that as well. Not sure if it's here. Okay, give me a second. I'll show you. Yeah. So 10% discount factors. Yeah. It's always 1.0009. Year 2, it is 0.826. Year 3, it is 0.751. Year 4, it is 0.683. And year 5, it is 0.621. Okay. Now you can get the present values. So this will be this figure multiplied by the discount rate. So the same thing you can get for all the years. Okay. Let's again make it whole numbers to make life easier for us. Okay. So you will have the present values, which is minus 3,200, 1,466, 1,138, 937, 859, and minus 13. Okay. Now, if you want the net present value, then you have to take the total of all of these figures. So that will be a positive 1,187. Okay, a positive 1,187. Here itself, okay, let me just get myself some space here. Here itself say, since the NPV is positive, company will accept the project. Okay, this saying this on its own gives you 1 mark. So always say the final answer. Is it financially acceptable or is it financially not acceptable? So if you make that point, that will definitely give you a mark. All right. So this is how you can do an NPV question. Easy, 8 marks for you at your exam. So the new point that I wanted to talk about was the tax allowable depreciation and how to do these adjustments. Okay, because this one, I think in a previous question, we did it on a straight line basis. We did the same tax allowable depreciation on a straight line basis, but there is a very good chance that they will ask you to do reducing balance basis as well. Okay, so I don't want you to be stuck then. That's why I chose this particular question. Right. So I told you there is a way to do the NPV calculation using the spreadsheet itself. Okay. I can show you. Okay, so I will show you because there may be some of you who don't know. But I won't advise you to use it if you're not comfortable. If you are comfortable, then no problem. Okay, but if you're not comfortable, then avoid it because it will only save you maximum 2 minutes. Okay, it's not going to save you anything more than that. So that is why I will not recommend it. So how you have to do it is till this point. Okay, so this is obviously not there. Till the after tax cash flow, it's the same. Okay, the only thing is you don't need to get the discount factors or the present values and multiply it. You can directly use the spreadsheet to do that. So let me show you how that works. But then again, if you're going to use the spreadsheet, you can't have the investment as part of the structure itself. Year not, you can't in fact include it at all. Okay, so you have to do the calculation year 1 to 5 and then you have to do year not separately. So this is how it will look like. Then what you should do is, now if you want to calculate NPV, you can press the equal sign, type NPV, open brackets. You have to write the rate. So the rate over here, average cost of capital 10%. So let's say 10%. Then put a comma and then just highlight all the numbers. Okay, so you will get 4,388. That is the present value of future cash flows. The present value of future cash flows is 4,388. Now to this figure, you have to subtract the investment. So the investment, if you remember, it was 3,200. Then you get the NPV. So that is 4,388 minus 3,200. You'll get the same NPV of 1,188. Okay, so 1,187, 88, rounding things, that's not a problem. You can easily basically get the NPV without including, this thing. All of these, the discount factor and multiplying it, you don't have to do. Okay, so what do you do? Basically, you have to have year 1 to 5. You can't include the investment year. Year not has to be done separately. So you will have year 1 to year 5, get the after-tax cash flows. After that, you can get the present value of these future cash flows. How do you do that? The function is press the equal sign, NPV, open your brackets, give the percentage of the discount factor. And then you have to just choose the cash flows. And then you will get the present value of future cash flows. To this, you have to deduct the investment and you will get the NPV. At your exam, this is 100% allowed. Okay, so if you're comfortable with it, you can by all means go ahead and use it. But if you're not comfortable, then don't, burden yourself because, getting the discount factors and the present values, it's not going to take so long. You just have to put in these factors and multiply. Multiplication also, if you do just the first one, you can drag this and you can get it for all the years. Okay. So I'm just giving you that in case you're comfortable, you can use it. All right. Fine. So that's all for that A part, which is the 8 marks. So if you can say all of this, give the numbers, you will get your 8 marks easily. Okay. Let's look at the B part. It says, DISCA company has limited the capital investment funds in its Delta division to 7 million. Okay. The division has identified 5 possible investment projects as follows. Now, what they're trying to say is, in this Delta division, we have given them like a quota. 7 million is their quota. Whatever investment they do in this Delta division, they have to do within 7 million. Okay. Now, there is a term we use for this. We call it capital rationing, meaning we are only giving them a fixed fund. We are not going to give them unlimited funds. So what are they saying? Using this 7 million, we have to decide basically what is the best investment for us to go for. So they're saying there's a project A, the initial investment is 3 million, the net present value is 6 million. Likewise, they've given for 5 projects. Then they're saying these projects are divisible and cannot be deferred or repeated. Project C and E are mutually exclusive. So divisible means you can do part of the project. So if you have only, say, now this is 3 million. No? If you have only 1 million, then you can do 1/3 of the project, no problem. You will get 1/3 of the NPV. Okay, so in project B, in the 2 million, if you only have 1 million, you can do half the project, no problem. You will get half the NPV. It's divisible. Okay. And mutually exclusive means if you're doing project C, you can't do project E. If you're doing project E, you can't do project C. Requirement: determine the net present value of the optimum investment schedule for the delta division. Okay, so let me work this out. So I'll just first, type what they're saying here. We have different projects. What are they? A, B, C, D, and E. Those are our projects, A, B, C, D, and D. Okay. Now, the initial investment, okay. You know what? I'll just go to another sheet, okay, because I don't want to. At your exam, you won't have a problem, guys, because there will be a separate spreadsheet under A, requirement A, and a separate spreadsheet under requirement B. So even if you adjust the columns, you won't have a problem, okay? Right. So then we have the initial investment. A, it is 3 million. B, it is 2 million. C, it is 1 million. This is also, D is also 1 million. And here it is 2 million. Okay, I'm just copying the question. Then we have the different NPVs. Here it is 6 million. Here 3,200,000. 1,700,000. 2,100,000. And finally 3,600,000. Okay, so those are the NPVs. Now they're asking us what is the NPV of the optimum investment schedule. So they're asking you what is the best investment schedule, best investment plan. Okay, so to do this, you have to calculate something called a profitability index. If you remember, it's called the PI. Okay, we call it the PI. Right. So how do you calculate profitability index? It's very simple. You take the NPV and you divide it by the initial investment. So the NPV is 6 million. You divide it by 3 million. That's 2. So likewise, for all the projects, you have to calculate it. It's given to us easily. Now what you have to do is you have to rank the projects. Okay, how do we rank it? The highest profitability index, it will go with rank 1. Okay, so in this case, the highest is what? 2.1. So that is only rank 1 first. The next one that we have is 2. So this is the second. Then the third one that we have is 1.8. That's the third. Now you have to be careful here because E and C, they told us, I'll highlight it. They are mutually exclusive. So if you do E, you can't do C. Okay. So now, although after 1.8, technically this should be the fourth, we can't do it as the fourth because when we do E, that's the third. Now you can't not do E and do C because E is only more profitable. You have to do E, but if we do E, we can't do C. So this has to be excluded. Okay. So finally, the fourth one will be 1.6. Okay. So now we know that we have to do our projects in this order. First, we have to do project D. Once we are done with that, if we have extra funds, we have to do project A. Then if we have extra funds, we have to do project E. And then finally, if we have more, then we have to do project B. Okay, so now let's type our optimum investment schedule. Optimum investment schedule. Okay. So how much do we have now in hand? First, we have to remember that we only have 7 million in hand. for $7 million. Right. So the first project is D, right? So let's do that. Project D. And what is the initial investment in project D? It is 1 million. Okay, it's 1 million. So I'll copy this. Okay. And the NPV that we will get, I'll copy that as well, 1 million, it's 2.1 million. Okay, that's 2.1 million NPV. So once we are done with D, you have to understand from the 7 million, we have already used up 1 million. So now we only have 6 million remaining. So first is done. Let's go to the second one. We can do project A. These are the details. Okay, we can do project A. Now, if you look at the investment, we have used up from the 7, we have used up 4 million. Okay, so now we only have 3 million remaining. So let's go to the third option that we have, which is E. It's only asking for 2 million. We have 3, so we can do the entire project. E. Now we have used up 3, 4, 5, 6 million. So finally, the last project we can do is project B, but we can't put in the entire 2 million because we only have 1 million in hand. Okay, so how much can we do? We can only do B as an initial investment. We can only put 1 million. So I will write 1 million. And if we invested 2 million, we will get an NPV of 3.2 million. But now we are only investing half now. So we will only get half of that NPV. So 3.2, half of that is 1.6 million. That will be the NPV that we get. Okay. Now we can get totals here. Let's call it the total. The total investment is going to be 7 million. So that's what we had, no problem. And the total NPV, can just drag this. It's going to be 13.3 million. Okay, so we have answered the question. It's a good idea when you have something like this to highlight it, so the examiner knows exactly what you're looking for. Okay, so the answer is 13.3 million. Okay. Right. So the last two parts of the question, they are asking you, discuss the reasons why hard and soft capital rationing occur. Okay. So I told you that this 7 million, if they're giving you a quota of 7 million, then it means that we have something called capital rationing. That means they are giving us a fixed amount. We can't go beyond that. Now, when it comes to capital rationing, there are two types of capital rationing, hard and soft. Hard capital rationing means the company is forced to limit their funds because an external party is kind of imposing that on the company. For example, the bank, they may not be willing to give any more debt because most probably the debt is too high. Our gearing is high. They find our company risky. So they have now limited the amount of debt that they are willing to lend to us. So now whether we want to increase it or not, whether we want to spend more or not is not a problem. It's not even a question because we don't have that money and nobody is willing to give it to us also. So then what happens? We are forced to actually do capital rationing and make do with what we have. Hard capital rationing. Soft capital rationing means maybe the company has capacity to increase funds. Maybe they have the funding required, but for some reason, the management thinks that they have to only have a limited amount to work with. Okay, so they are giving the Delta division only 7 million, although they may be having more. The reason why they can do that, one reason is sometimes companies may want to keep some cash as a reserve in case something unexpected happens. So they don't want to put all their money into the investments. They want to have something as liquid cash, one reason. Another reason could be that if we have limited finance, then we will make sure that we invest in only the best projects. If you have a lot of money, then you will just invest in all the projects available. But that is also not good for the business, right? So if we want the business to invest only in the best projects, then one way to do that is to limit the finance. So now what will happen? Different projects will have to compete with each other and only the best one will get the investment. Okay, so those are the reasons why hard and soft capital rationing occur. Then the D part. So basically this 5 marks, how you have to work around it is 1 mark you can talk about generally what is capital rationing. Then 2 marks if you can talk about hard, and 2 marks if you can talk about soft. So hard you can define it, say what it is, and then maybe you can give an example of a hard. For example, the bank is not willing to give you any more funds. Soft capital rationing, you can give you can talk about what it is, and an example you can say why. Maybe because we want the projects to compete with each other. Okay, so that will give you an easy 5 marks there. Right. So you can see, right, in 20 marks, 9 marks is entirely theory based. In fact, 10, because the financial availability, that acceptability gives 1 mark. So actually this question is exactly divided 50-50 into theory and calculations. D part is saying discuss 2 ways in which the risk of an investment project can be assessed. Okay. So if you want to incorporate risk into investment appraisal, listen to me carefully. There are only 2 ways you can do that. One is you can use something called a probability analysis. The other one is you can use the capital asset pricing model. Okay. So if you want to incorporate risk into investment appraisal, these are the 2 techniques that you can use. Okay. So let me talk about the CAPM first, capital asset pricing model. What are the types of risk you can incorporate in CAPM? You can incorporate business risk and financial risk. Okay, what is business risk? It is the risk that you will incur simply because you are in a particular industry. Okay, so an industry, it might have a particular risk. For example, we have Kaplan, right? Kaplan is an industry. I mean, they are in an industry where they publish books. So one risk that they always have is the book becoming outdated. So Kaplan will have that problem, BPP will have that problem, anybody who is in the publishing industry will have the problem where the books get outdated. So that is an example of a business risk. A financial risk means that is specific to a company. It is not specific to the industry, it is specific to the company. So what I mean by that is, if, for example, there is a company A and a company B, company A has 80% debt, 20% equity. Okay. Now debt, although it's cheaper, it's riskier. Why is it risky? Because in case we default on our interest payments, the bank can come and seize our assets. Okay. So that is always a risk. Whereas another company, maybe they have 20% debt, 80% equity, less debt. In that case, we say that company A has more financial risk. Why? Because they are highly geared, and company B has less financial risk because they are, they have less debt in their capital structure. So to put how CAPM comes into this whole thing, it's like this. We have one company A, company B. Okay. Now let's say company A was in one particular industry. Let's say they were in publishing, book publishers. Let's say they are Kaplan. Okay. They know the risk of the publishing industry. Let's say for some reason, company A, they want to go and invest in a completely different business. They want to go and invest in, let's say, spare parts. Okay, they want to invest in something else, spare parts. Now, company B, let's say they specialize in spare parts. Now, what you have to understand is, Kaplan, they know about the business risk of publishing. They have no idea about business risk of spare parts. Okay, they don't know about the spare parts business at all. So they don't know the business risk. So if they want to, carry out an investment appraisal in the spare parts business, it's best for them to kind of consult company B a bit, because company B knows the business risk of spare parts. So how do we do that? Using the beta factor. Okay, we use the beta factor. So what is this beta factor? You should be knowing it at this point. Anyway, I'll explain it also. There are 2 types of beta. There is something called a beta asset and a beta equity. 2 types of beta. Okay. Beta asset, it reflects only the business risk. Risk only. Okay, only the business risk. So if you have a beta asset of 0.7, it is only reflecting the business risk. Whereas beta equity, it's reflecting the business risk plus the financial risk, both. Okay, it's reflecting the business risk plus the financial risk. Now, what you have to understand is company A, they will have a particular finance structure. Company B will have a separate financial structure. Like they may be 80% debt, they may be 60% debt. Okay. So what we have to do is we have to take only the beta asset of company B, because the business risk is going to be the same if we are also going to go into spare parts. So we have to take company B's beta asset. Thing is, no company will publish the beta asset. If you're quoted, you don't publish the beta asset. They will only publish the beta equity. They will only publish beta equity. So what you can do is you can de-gear the beta equity. There is an equation for that. Okay, the equation is given over here. I'll show you quickly. This one, asset beta formula. If you use this, you can de-gear the beta equity to find beta asset or the asset beta. Now, this asset beta, it is only reflecting business risk of the spare parts business. So, what you can do is use this asset beta for company A. Okay. And now you can add in financial risk of A. So that means we are going to re-gear the asset beta. Again, using the same formula, you have to do that, and you will get a risk adjusted equity beta. A risk adjusted equity beta. So when you do this de-gearing of beta equity, what you do is basically you remove company B's financial risk. That's what you do. You remove their financial risk. And you get the asset beta. So it is only reflecting the business risk of spare parts. Okay. Now that asset beta, you use it for company A. Company A obviously has a different capital structure. So we have to add the financial risk now to this asset beta. That's why we re-gear it. Okay, and when we re-gear it, we will get an equity beta, and this is called a risk-adjusted equity beta. This, when you use in the CAPM formula, if you remember, this is the CAPM formula. So risk-free rate plus beta equity multiplied by the market return minus the risk-free rate, or you can call this the risk premium as well. Okay, so if you use this risk-adjusted beta that you found, if you use it in the CAPM equation, then you will get a cost of equity that is risk-adjusted. That you can use in your NPV calculations. You can use it with, maybe if you want, you can add the cost of debt and then use it in the NPV calculation. Whatever answer you get, we have taken into account risk as well. Okay, so if you can explain this, guys, why I took time to explain this is it's a very famous question. It's a very famous question. If you can just say, now company B, there's a name we give it. We call it a proxy company. Okay, we call this the proxy. If you can just say these things, okay, these are all 1 mark. If you say get the beta equity of a proxy company, de-gear that beta equity to remove the proxy's financial risk and find the beta asset, reflecting the business risk for company A's new venture. Once you get the beta asset, to add in the financial risk of company A, you have to re-gear that beta. Once the re-gearing is done, you get a risk-adjusted equity beta. If you use it in the CAPM formula, you will get a risk-adjusted cost of equity. So that when you use in the NPV calculation in investment appraisal, that will basically give you a risk-adjusted. The question itself asks here, it will reflect the risk of an investment project. Okay, so if you can say that I know here it's only 2 marks, okay, so you can just even give 1 or 2 points of what I said, but there have been situations where they have even asked the same question for up to 8 marks. Okay, because again, every point gives a separate mark, right? So that is the CAPM. So the other one, probability analysis, I'll just show you the marking scheme. I don't want to waste time with that. So yeah. Yeah. So here, see, the CAPM is what I explained so far. Probability analysis, it says here, project risk can be assessed or quantified by attaching probabilities to the expected investment project outcome. Okay. So basically what you have to say is, I know that they have given a lot of information here. You can have a read through if you want, but basically probability analysis means for every figure that you have, if you can figure out what is the probability of it actually happening, you can multiply the probability with the cash flow, get an expected value, and using the expected value, you can carry out the investment appraisal. So that way also we have taken into account the risk. Okay, so these two, only 4 marks, like I said. So if you can just make 2 points about each, that will be more than enough. But again, I'm focusing on the CAPM. You have to be able to, explain the entire process and obviously do it as well. You should be able to do the calculation too. If you can do it, you will be in a very good position. Okay. Right. So that's all for that question. 7:10. You can take a break and come back. We will focus on MCQs after this. Okay. So if you can take 15 minutes, you're talking about, yeah, be back at about 7:25 and we will focus on the MCQs. And if you all have any questions also, you can feel free to ask me anytime. Okay. Okay, I'm sorry, I just saw your questions. How to do TAD with a straight line Shagana? I did a question. In the TRG itself, I did a question where we did with a straight line and a residual value. Please go through. I think I'll tell you the name. Let me check. Give me a second. I'm not sure which TRG, but if I give you the name of the question, it will be easy for you to find it. Degnis. I think it was the very first TRG. Degnis company. It's the first TRG. If you just go through that question, I teach you how to do TAD with a straight line and residual value also will be given. Why have they said assume at the start of the year of operation for TAD? Because, again, this is a tax thing where the TAD, you don't calculate it at different points of the year. It's like this. Even if you buy a machine on December 30th, I'm just saying December 30th, still December 31st, we will have to calculate this TAD because it's calculated at the end of the year. Taxation authorities tell you calculate at the end of the year. Whereas depreciation, there is a concept now where we can, just charge depreciation for 6 months, for 3 months, 1 month. That you can't do with TAD. That's the problem. Okay, so that is why they say assume that the start of the year of operations is, they say, I think, what did they say in the question? Year not, if I'm not mistaken. Okay, the reason why they have to say that is because of the tax implication. Like I said, there is no way for you to, spread it out, or, there is no way for you to apportion that particular TAD cost. It is anyway calculated at the end of the year, whether you bought the machine on day 1 of the year or day 360 of the year, doesn't matter. The TAD has to be calculated. Again, don't think about it too much. This is definitely something that you will be comfortable once you're done with the F6 or taxation paper. Okay, I don't want to talk about it in detail because no point, right? At this point, especially with 10 days to the exam, no point breaking our heads over it. What you remember is, I'm telling you, if you're doing the tax allowable depreciation, if the tax is paid 1 year in arrears, the tax savings always happens in year 2. Okay, because almost all the time we will assume that year naught is when we start off the calculations. So the first savings will happen in year 2. If you can keep that in mind, that's more than enough. Of course, if it is 1 year in arrears, if it is one on the year of the cash flow itself, then it will start in year 1. Okay. Right. So yeah, take a break and come back. I'm sorry, it's already 7:12. It's fine. 7:25, 7:30. We will start with the MCQs. Okay, so I hope you guys are back. Let's start with the MCQs, okay? Okay, so it says here, this is section A. Okay, so as you all know, there's a section A and a section B. A is basically small questions. Okay, each of them will be independent. So it says here, each question is worth 2 marks. Which of the following is an advantage of implementing just-in-time inventory management? So you should know that just-in-time inventory management means we are not going to hold inventory in stock. Okay, we are not just going to produce and keep it in a warehouse. We will only produce if the customer places an order. So the first thing or the initiation is done by the customer. Only if they place the order will we start the production. So they're saying which of the following is the advantage of that. Let's read it one by one. Quality control costs will be eliminated. You can't say that it will be eliminated because even if we are going to produce after the order, we have to still make sure that we don't have any defects. So definitely there will be some quality control costs. We can't completely eliminate it. Monthly finance cost incurred in holding inventory will be kept constant. It can't, again, we can't say that it's going to be constant. Why? Because, yeah, we have a just-in-time system. In 1 month, we will have one amount of orders. In another month, there will be something else. So obviously, the finance cost is going to fluctuate. Okay, so we may be having we may be having no stock at all at one point, but maybe at one point in time, we might have a little bit of stock. So we can't say that every month finance cost is going to be the same. That is obviously not possible. The frequency of raw material deliveries are reduced, actually is increasing. It increases. Why? Because we are going to now produce in smaller quantities, most probably. So if we produce in smaller quantities, the amount of raw materials we order also will be smaller. So then the number of times they come will increase. Okay, so C is the opposite. That is wrong. The amount of obsolete inventory will be minimized. That is true. Obsolete means inventory that we can't use anymore. So since we are trying to keep the inventory at a minimum, the chances of that inventory getting obsolete is very less. Okay, so the answer will be D over there. Okay. Then it says, which two of the following activities carried out by a financial intermediary? So financial intermediary, the best example that we know of is a bank. Okay, it's a bank. So think of what the bank will do. Let's read them one by one. Transforming interest rates, we don't really transform anything. We don't try to match interest rates or anything, right? We set an interest rate and that will change from time to time, but we are not going to bridge any interest rates or anything of that sort. So A can't be the answer. B also can't be the answer. We are not transforming foreign exchange also, but we do transform maturity and risk. So what is transforming maturity? Simply the depositor. Okay, the depositor might be willing to deposit only for 1 year. Whereas a borrower, he might be wanting the cash for maybe 3 years. Okay, so in real life, if they were to meet each other, then obviously it won't work because one person will say, I can only give for 1 year. The other person is going to say, I need for 3 years. So what the bank does is they stay in the middle and they make sure that we kind of match the time that the depositor is giving and the amount of time that the receiver wants. So how do we do the matching? We can match it because we have multiple depositors and multiple borrowers. Okay, so that is one thing that the bank definitely does. Then transforming risk. Again, if there was no bank, you go and lend the money to somebody, something happens to that person, he dies or, he goes bankrupt or something, then you have most probably lost your money. But if it is the bank, then since we give it to the bank and the bank is going to pool all the funds and then give it to many borrowers, the risk of you losing your money is actually very minimal. So the two things that the financial intermediary does, one, it transforms maturity. The second one, it transforms risk. Okay. Right. Then we have the third one. Frost Company is planning a 1-for-4 rights issue with the issue price of 10% discount to the current share price. The EPS is currently 0.5 and the shares of Frost Company are trading on a PE ratio of 20 times. The market capitalization of the company is 50 million. What is the theoretical X rights price per share to 2 decimal places? Now, what is a theoretical X rights price? There is a formula that you have to know. It's this. Copy it. To calculate the theoretical X rights price, you need the market value of shares already in issue. Okay, the market value of shares already in issue, proceeds from the new share issue, and you divide it by the number of shares in issue after the rights. Okay. So first, let's figure out what is the current market value of a share. Okay. Nowhere here is it giving you the market price per share directly. Okay. All they are giving you is the EPS, earnings per share, and they are giving you also the PE ratio. So we have to do something with these. And then they are saying about the 10% discount. They're giving a market capitalization. But even if you're going to get market capitalization, you can divide this by the number of shares. That also it's not very clear. We don't know how many shares we have. Yeah, so we can't get it with the market capitalization. So let's look at EPS and the PE ratio. So we know one thing, EPS is calculated like this, the earnings, total earnings, you divide it, okay, we divide it by the number of shares. That's how we calculate EPS usually. Okay. And the PE ratio, how do we calculate it? If you remember, it is the market price per share. We divide it by the EPS, earnings per share. That's how we calculate PE ratio. Okay. Now, let me just multiply this PE ratio by number of shares. Okay. Because if I multiply the numerator and the denominator, it's essentially the same number of shares. Now, if I start cancelling off this number of shares, that will get cancelled with this number of shares. Multiplication. Okay. Those two will cancel each other off. EPS into number of shares, that is the total earnings. So that is going to cancel off with this earnings. So ultimately, what we have remaining is the MPS or the market price per share. So if you take the EPS and you multiply it with the PE ratio, you will get the MPS or the market price per share. Okay. So MPS will equal to the EPS, which is 0.5 multiplied by the price earnings ratio of 20. So the market price per share currently is $10 per share. Okay. So now to get ERP, we need the market value of shares already in issue. It's like this. We have 10. Okay, we have 10 as the market price per share. If we multiply that by 5. So how do we get the 5? That's the number of shares. It's basically the market capitalization. Give me a second. Okay, so now this is the market price per share. If I multiply it by the number of shares in issue, we can get the total market value of the shares in issue. So now I have to calculate the number of shares in issue. How do I do that? I have the market capitalization. That is 50 million. Okay. So if I divide this 50 million by 10, that is the market price of one share, I will be able to get the number of shares in issue. Okay. So number of shares in issue is going to be 50 divided by 10. 5 million shares in issue. Okay. So if I want market value of shares in issue, I will take 10 and multiply it by 5. Then plus proceeds from new share issue. Okay, so let's see what the new share issue is. We know that the rights issue price is 90% or it's at a 10% discount to the current share price. So it's going to be 10 into 90% of that. Then only you get a 10% discount. So this is going to be 10. Obviously, 90% means it will become 9, but you can show the workings, no problem. Okay, so rights issue price is 9. Now we have to find out how many shares did we actually issue as rights issue. Okay, so for that, we know that the total number of shares that we have is 5 million. Okay, and if you had 5 million shares, the ratio is 1:4. Okay, so this 5, if you divide rights issue, that's the 5, if you divide it by 4, 1.25 million shares you have issued in the rights. Okay, now we have everything that we need for us to calculate the TERP. So the market value of shares already in issue, that is going to be 10 into 5, again market capitalization, same thing, plus proceeds from the new share issue, 9 into, we issued 1.25 shares, divided by the number of shares in issue after the rights. So now earlier we had 5, plus now we have 1.25. Okay, 5 plus 1.25, so that will become 6.25. So when you put this in your cal, you should get the TERP as $9.8. Okay, $9.8. Okay. Then it says, which of the following statements in relation to business valuation are true or false? First one is saying, the earnings yield method and the dividend growth method should give similar values for a company. Okay, so I'll quickly take you to a slide which has a quick summary. Business valuation. So this is a summary of all the different methods that you have to value a business. Okay. So let's go through just that slide. Okay, this is the summary. Okay. So if you want to value a business, guys, there are 3 methods. One is you can go for an asset-based method. Asset-based means you basically calculate the total value of all that company's assets. Simple. Okay. If they have different assets, land and building, if they have machinery, if they have any asset, whatever it may be, machinery, anything, you will consider the book values of all those assets or the market values of all those assets or the net realizable value of all those assets, add it up and call that the business's value. First method. The other method is called an income or a earnings based method. So income or earnings based is usually used only if you're going to acquire a majority share able to company's earnings. Because earnings is something that only majority shareholders can influence. Minority doesn't have a say. If you're going for an income or earnings based method, you can either go for the PE ratio, which is the earnings into the PE, or you can go for an earnings yield method. And why do we say that? Because the earnings yield is the reciprocal of the PE ratio. Okay, the earnings yield is usually the reciprocal of PE ratio. So if PE ratio is MPS over EPS, earnings yield is EPS over MPS. Okay, so the total earnings is multiplied by 1 over earnings yield because it is earnings into PE. Since this is a reciprocal, it becomes 1 over earnings yield. Okay, and if we want to incorporate growth in earnings also, we can do that using this particular formula. That is the income or earnings based method. Cash flow method, you have 2 methods that come. One is the dividend valuation model, which you will use if you have a minority shareholding. Because minority shareholders, the maximum that they can get out of the business is the dividend. Okay, so you can use the dividend valuation model. But if you're a majority stakeholder, if you're going to acquire a majority of the business, then you can use the discounted cash flow basis as well. This is a summary of the entire business valuation chapter. Okay. Now, keeping this in mind, let's move to the question. So, it's saying, which of the following in relation to business valuation is true or false? Earnings yield and dividend growth should give similar values. That is false, because earnings yield is a income or earnings based method and dividend growth is a cash flow based method. So, two different methods, it can't give a similar value. So, that's false. Market capitalization represents the maximum value of a company. Market capitalization is simply the number of shares multiplied by the share price. Okay, now that is not maximum. Okay, because sometimes when you take over another company, you will value it higher than the market price, because for example, you might get synergies. Okay, you might have some other benefit. There may be a brand name. There may be a good workforce. So those kind of things will usually add to the value of a company. So market capitalization, it's not necessarily the maximum value. Okay. The PE ratio is the reciprocal of the earnings yield. That is true. Okay. Earnings yield, PE ratio, they're the reciprocal of each other. The PE ratio should be increased if the company being valued is riskier than the valuing company. Now this PE ratio, it's a very common ratio that they calculate at the stock exchange. Now, if the PE ratio is high, okay, if the PE ratio is high, then usually we consider that business to be good. It's a good business. Okay. But if the PE ratio is low, then we consider that business to not do so well. So if you're an investor, if you find a company with a high PE ratio, then you tend to easily invest in that company. So now they're saying if the company is riskier, then that's a bad thing. Okay. So if the company is riskier, then the PE ratio, it will actually decrease. It won't be increasing. Okay. So it increasing, that's wrong. Because risky is a bad thing, and that will reflect by having a lower PE ratio, not a higher PE ratio. Okay, so that's false. Then the fifth one is saying small and medium-sized entities have restricted access to capital markets. Okay, they have restricted access to capital markets. What is the term given to the difference between the finance required to operate a SME and the amount obtained? So what they're saying is, if you're a medium-sized entity or a small entity, you have a problem where you require a certain amount. You're not able to raise that amount. Why? Because maybe the bank is not willing to lend to you. Investors are not willing to buy shares in your company because you're still small. Okay. So you require one amount. Okay. So in terms of the funds, you require one amount, but you can obtain only a smaller amount. Okay. So this, let's say this is 500,000. What you get is only 450,000. Okay. So there is a gap of 50,000. What is that gap called? Okay. So if you don't know the theory here, you would have a problem. I'm telling you now, that gap, it's called the funding gap. Okay. It's called the funding gap. So the answer is C. It's not a forecasted gap. A maturity gap is to do with times. Okay. If you want for one period, you want for 5 years, you're only able to get for 4 years. That is maturity, to do with the timeline. Funding is to do with the monetary value. Asset gap, again, forecasted and asset is not part of the syllabus. Okay. So the answer there will be C. Right. Then the sixth one, Max Company is a large multinational company which expects to have a 10 million cash deficit in 1 month's time. The deficit is expected to last no more than 2 months. Okay, so we need this money in 1 month's time only for 2 months. Max Company wishes to resolve its short-term liquidity problem by issuing an appropriate instrument on the money market. Which of the following instruments should Max Company use? Now, what you have to understand is the money market naturally only deals with short-term instruments. So if you want a loan for less than 1 year, or if you want to deposit for less than 1 year, only then you can use the money market. So Max company going to go for the money market is a good thing, because capital market means we are talking about long-term instruments. Okay. So now in the money market, there are different type of instruments that, you can just have a quick idea about. I'll show you that quickly. Yeah. So I'll just show you the money market. Yeah. These are the different types of instruments that you can have in the money market. Okay. One is called the discount. I mean, these are the different markets that is within the money market. One is called the discount market. Discount market means whatever bill. So bill means it's like basically like a share in the stock exchange. When it comes to debt, we call it a bill. Okay. It's traded at a lower price than the quoted price, than the nominal value, then you will be in the discount market. Okay. The interbank market means basically a market where banks can lend each other short-term funds. Only banks will lend each other. Euro currency market means if the bank, they want to trade in foreign currencies. Okay, if they need foreign currency, somebody is coming and asking for a certificate of deposit in another currency, then you have to use the euro currency market. Then there is another one called the certificate of deposit market, the local government market, an intercompany market, and a finance house market. So you don't have to know details of all of this. What I want you to understand is simply this. Okay. If you need a short-term source of finance, less than 1 year, then you have to go for the money market. First thing. In the money market, there are different types of instruments. So now looking at the question, we have to decide which one actually fits into our criteria. So let's go here. Let's go from down. Treasury bills. Treasury bills, what is that? It is basically the government, they issue something called a treasury bill. So if the government wants money, they issue treasury bills. You as the public, you can buy it. With time, the government will pay you an interest and they will repay how much ever you bought the bill for. Now, that is not in any way, syncing with what this company wants. The company wants money. The company can't issue treasury bills, right? Treasury bills are issued by the government. So definitely not D. Corporate loan notes. When we are talking about loan notes, most of the time, it is for more than 1 year. Loan notes means most of the time it's for more than 1 year. So that also can't be an answer. Interest rate future, it's not a method for you to actually get money, it's not a funding strategy. You can't fund your business in the future. It is a hedging technique. Okay, so if you have interest rate risk or if you have a foreign exchange risk, you can reduce that risk by purchasing or selling or buying interest rate futures. It has nothing to do with you getting money. So it can't be B. So the only thing that fits into this is the commercial paper. Why? Because that is also something that you can issue. Like a share, you can issue a commercial paper. Somebody will buy it. Usually it's for the short term, less than 1 year. And you can repay that person once you're done with that period. So after 2-3 months, you can repay that person. So the only thing that fits into the criteria is the commercial paper. Okay. Then in relation to capital markets, which of the following statements is true? So capital market means we are talking about the long-term market, stock exchanges, for example. Okay. It's saying the return from investing in larger companies has shown to be greater than the average return from all companies. They're saying if you invest in a large company, you will get more return than the average from all companies. That may not be true. Just because a company is large, it doesn't mean the return is also going to be large. Okay. Weak firm efficiency arises when investors tend not to make rational investment decisions. Weak firm efficiency means the share price, for example, it is not reflecting all the information that is available even publicly. Okay, so it will reflect maybe past share movements and stuff, but even publicly available information, it is not reflecting. Okay. So that and investors not making rational decisions are two different things. Okay. So it doesn't make sense. That there is no way to explain that statement really. Okay. So it can't be B. Allocative efficiency means that transaction costs are kept to a minimum. That is not allocative. That is called actually operational efficiency. Okay, so in case you're interested, it is not allocative. If you want to keep transaction cost to a minimum, that is called operational efficiency. Then D is saying research has shown that over time share prices appear to follow a random walk. That's true. According to research, if you are in the share market, you will realize that no matter what, suddenly share prices increase, suddenly share prices decrease. There is no real reason behind that. We can't really predict 100%. That's why we say it follows a random walk. Okay, so the answer there, the correct one is D. Okay, the following data is available. I'll give you a minute since this is, it is a calculation. I'll give you about maybe 3 minutes. See if you can get what the forward exchange rate is in country Y. Okay, so try that out. Yeah, I told you this allocative efficiency, it's called operational, right? I forgot to tell you what is allocative. It's actually not financial management. It's more to do with economics. Allocative efficiency means basically the goods and services in the economy. They exactly match the wants of the needs and the wants of the people in the country. Okay, so basically that is allocative efficiency. Definitely not part of the syllabus. It's just given. Okay. If you studied 100% of the syllabus and you see something out, then chances are that can't be the answer. But if you only studied 80% of the syllabus, then you won't be able to take that call. Okay. Okay. So let me read this. It says country-wise currency is the dollar, country X is the peso. Country-wise interest rate is 1% per year. Country X's interest rate is 3% per year. Country X's expected inflation rate is 2% per year. Spot exchange rate in country Y, 1.6 peso per dollar. They are asking what is the 6-month forward exchange rate in country Y. They're asking for a forward and they're giving you interest rates and spot rates. It should immediately strike you that you have to use the interest rate parity theory. Okay, interest rate parity. You shouldn't have a problem because equation is already given to you. The forward rate F naught equals to the spot rate S naught multiplied by 1 plus the interest of the counter currency divided by 1 plus the interest rate of the base currency. Okay. So that is the equation to get the forward rate. So thing is they are asking for a 6 months forward rate. Okay. So the interest rate, you have to be careful. They're giving yearly rates, annual rates. So you have to convert that to 6 months rates. Okay. So let's do that quickly. The spot rate they're telling you is 1.6. So that multiplied by 1 plus the interest of the counter currency. So if you see country X, okay, now if you look at the spot rate, they're giving it per $1, right? That means the base country is the dollar. That means the base is the dollar. For $1, we are giving the peso exchange rate. So if we want the interest rate of the counter currency, you should get the interest rate of the country where they are using pesos. So the country that's using peso is country X. So country X's interest rate is 3% per year. Okay. So 1 plus 3%. This is annual figure. We need a 6-month rate. So into 6/12. This you divide it by 1 plus the interest of the base currency. I'm just putting it all in one line. 1 plus the interest of the base currency is 1% per year. So that will be 1% into 6/12. Okay. So if you put all of that in your cal, you should get a forward exchange rate for 6 months as 1.62. This is F0. Okay, 1.62. So you have to be careful. Remember, if you have an exchange rate given like this, that means we are talking about $1 being the base currency. Okay, that means the base country is the dollar. You have to know that. If you didn't know that, then you will be very confused with this question. Right. Can try the next one as well. Green Company, a listed 1st December 2015. At the start of 2015, the share price was 2.5. Highest price in the year is 3.15. Lowest price is 2.4. At the end of 2015, it was 3. During the year, Green Company paid a total dividend of 1.15 per share. What is the total shareholder return for 2015? They're asking for TSR, total shareholder return. This equation is not given. You should know it. Right. So TSR equals to the change in share price plus the dividend paid, this whole thing divided by the beginning share price. Okay. So let's see, what's the change in share price? At the end of 2005, it was 3, and at the beginning, it was 2.5. So the change is 3 minus 2.5. Plus the dividend that we paid is very clear. It is 0.15. So that you divide it by the share price at the beginning of the year, which was 2.5. Okay, so take it here, okay? You know what I'm doing, right? So 3 minus 2.05 plus 0.15 divided by 2.5. So that should give you the total shareholder return as 26%. You can take it as a percentage. %. So the answer there will be A. Okay, so you can see the MCQs, the calculations, you might think it is simple, right? But one area where you can actually score well, even if you don't know the syllabus properly, is the theory-based MCQs. Because you can just use your common sense and eliminate the wrong answer. If you're not sure what's happening, eliminate the wrong answer. You can arrive at the correct answer. Okay? So don't ever underestimate the theory-based MCQs. Why I'm telling that is, even if you did some wrong calculation, there is a very good chance that the answer that you get in the wrong calculation is also part of this A, B, C, and D. So you will think, okay, my answer is there. You will mark it. You won't even think about it again. So there is a very high percentage of pupils actually getting the calculations wrong in MCQs, because there can be a chance, right, where you actually do something wrong, you get an answer, you see it, you mark it. But theory is not like that. It's very unlikely that you mark a wrong answer for a theory-based question. You just have to take a minute, think, and then choose your answer. Right. Then it says, the 10th question, Carp Company has announced that it will pay an annual dividend equal to 55% of earnings. Okay. Dividend they're going to pay equal to 55% of earnings. Its earnings per share is 0.8 and it has 10 million shares in issue. The return on equity of Carp Company is 20% and its current cum div share price is 4.6. What is the cost of equity of Carp Company? They're asking for cost of equity, which is KE. How can you calculate the cost of equity? I'll give you a minute to think about it, and then I'll go to a summary like business valuation, another summary, and then we'll come back to the question. Right. So to calculate cost of equity or KE, there are two different methods. Let me show you them really quickly. Let me just check if it's here. No, not here, sorry. Okay, so I'll take you to a summary. Is it? Yeah, it's here. So while we are at it, I'll go through how to calculate cost of equity and cost of debt both. Okay, so the entire cost of capital chapter, it's in these two slides. Okay, so if you have a problem with it, then focus here. Okay, what is cost of equity? First, you have to understand, if you're a company, you can decide whether you're going to issue shares and raise funds, or whether you're going to go for a debt, either a bank loan or issue something like a bond and get funds into your company. Okay. Now, if you have to find out what is the cost of this equity, meaning how much return are the equity holders expecting from me, then there are different ways in which you can make that calculation. Basically, the percentage. Now, for a bank loan, for example, we know exactly what is the cost of that debt. Why? Because the bank itself will quote 11% interest. So, the cost of that debt is 11%. Okay. But when it comes to shares, the shareholders are not going to quote, we need 10% dividend, right? There is a situation where that happens, and that is only if it is a preference share. Whereas if it is an ordinary share, then it is entirely at the, the company's decision to decide what dividend they are going to pay. Okay, but still we need a percentage, because only then we can use it for NPV calculations, for example. So we need that percentage. How do we calculate it? There are three ways in which you can calculate. In fact, two main ways. The third one is just another area. Okay. First is the dividend valuation model. So here we say that the market price of a share P naught should equal to the dividend times 1 plus the growth rate divided by the cost of equity minus the growth rate. So what we need to find actually is this RE or KE. We use both letters interchangeably. So if you want to get KE, if you have the market price of a share, if you have the dividend, and if you have the growth rate, you can rearrange the equation and get KE easily. Now, usually the market price, market value, the question has to give it to you. Whereas the growth rate, you can find. there are two ways to find it. One is this method called extrapolating past dividends. So if you have past dividends, then you can take the D naught divided by dividend n years ago over 1 over n minus 1. If you do that, you get G. Or you can use this Gordon's growth model, G equals BR. So what is BR? It is the retention rate into the accounting rate of return. So that is the dividend valuation model. Okay. Then there is a second model called the CAPM or the capital asset pricing model. So here if you want KE, it's the risk-free rate, which is basically the interest rate of treasury bills usually. Okay, because we consider treasury bills to be very low risk. Okay, almost zero risk. Plus beta. I spoke about this beta earlier today. It's the beta equity. So it is taking into account the business risk as well as the financial risk for that company times the market return minus the risk-free rate. So if you have these figures, you can use CAPM and find KE, cost of equity. Okay. And I spoke about using proxy betas, right? I told you if there is a risk change where you're going to, go for another industry, then you will take a proxy, re-gear, de-gear, all of those things. I spoke about it. This part is just talking about that. Finally, if you have preference shares and you want to find KP, at that point, we don't call it KE, we call it KP, K-pref, okay? You will divide the dividend by the market value of that preference share. These are the only ways in which you can calculate the cost of equity in your syllabus. Dividend valuation, CAPM, and the preference shares. Okay? So that's all about cost of equity. While we're at it, I'll speak about cost of debt as well. Okay? So if you have cost of debt, we are talking about 4 types of debt instruments. Okay, the one is very simple, non-traded. So non-traded means it's simply the bank loan. A bank loan, the cost of debt is simply the interest rate. But if you want a post-tax KD or cost of debt, then it will be the interest rate multiplied by 1 minus the tax rate. Simple. Then if you have irredeemable debt, if you want KD, it is the interest divided by the market value of that particular bond. Interest divided by market value of that particular bond. And if you want KD 1 minus T, so why am I saying this KD is different, KD 1 minus T is different? Because unlike the dividends, unlike the cost of equity, with cost of debt, okay, what happens is the interest that you pay, it will actually give you a tax benefit because interest is also a cost. It reduces the taxable cash flow. Okay, so sometimes they will ask you the post-tax cost of debt. So then you can't just calculate this and keep the first box. You have to calculate KD 1 minus T. So how you do that is interest times 1 minus T divided by the market value. That is if it is irredeemable. If it is redeemable, then you will calculate using an IRR-based calculation. So if you calculate an IRR, then the IRR percentage is only the cost of debt. But remember, you use IRR only if the redemption of that instrument, that debt instrument, if it happens at par, so that is $100, or if it happens at a premium. If it happens at the market price, if the redemption happens at market price, then you will treat it like irredeemable debt and use this equation. Okay, because the position is the same. Here also market value, here also redemption is at market value. Finally, you have the convertible. For a convertible, first you have to decide, are we going to redeem or are we going to convert? You have to choose the higher option, and using that, you will use an IRR again, an IRR style calculation to get the cost of debt. Okay, so I know I rushed through this. We obviously spend a lot of time learning all of this, but I assume that at this point, this is just a revision and you already have a very good understanding of cost of equity and cost of debt. Okay, so if you want, you can take a picture of this. It will help you because I have basically given a summary of all the different calculations you need for the entire cost of capital chapter. Okay. So that is debt and this is equity. Right. So now let's look at our question and see how we can calculate this cost of equity. So they're saying it will pay an annual dividend equal to 55% of earnings. The earnings per share is 0.8. It has 10 million shares. The return on equity is 20% and the current cum div share price is 4.6. Now, what you have to understand is if you are using DVM, okay, if you are going to use the DVM, then you have to have so many figures, basically. You have to have, let me see, the dividend, you have to have the growth, and you have to have the market price. Okay. So, obviously, we don't have any information to do with CAPM because either DVM or CAPM. CAPM means we need to have risk-free rate and all. They haven't given that. So, we know for sure we have to use the dividend valuation model. Okay. So, what is the dividend valuation model? Let me copy it. This one, this one, this one. Okay. So, let's see the information that they are giving us. Right. So, first we need the growth rate, right? Whatever it is, we need growth. We need the growth rate, but they're not giving us past dividends or anything. So, most probably this is out. We have to use G equals B into RE, Gordon's growth. So, let's calculate the dividend to be paid. Okay, because that's the first thing they're giving us, no dividend to be paid. How much are they saying? That is 55% of earnings. So, equals to 55% of earnings. We have the earnings per share as 0.8. So, the DPS, let me just check this, 55% of 0.8, okay, not 5. 0.44 per share. The dividend per share is $0.44 per share. Okay. Now we know that G equals BR. Okay. So in that BR, we need to know the retention rate. How much is the retention rate? 100 minus the payout rate, which is 55. So the retention rate is actually 45%. Okay. So if we want to get growth, that is going to be the retention rate, which is 45% multiplied by the return on equity. They're telling you that it is 20%. So the growth we're talking about is 9% per year. That's the growth. Okay, so we have the growth. Then we need to get the market value. So they're saying that the current cum div share price is 4.6. We can't use any cum div share price in dividend valuation model. It has to be ex div. So we take the 4.6 and we minus the dividend that is paid, which is 0.44. Okay. That will equal to, we have D naught, which is the dividend, current dividend, which is 0.44 times 1 plus G, which is 9%. This whole thing, you divide it by KE, which is what we have to find, minus 9%. Okay, this is this equation, same equation. Okay, so then you can put this in your cal. It will look like this, 4.6 minus 0.44, it should equal to 0.44 times 1 plus, 9% over KE, which is alpha x, because we don't know that figure, minus 9%. Always don't waste time rearranging and stuff, okay? So KE will be 0.205. So we're talking about 20.5%. 20.5%. So let's see if the answer is there. B. Okay? B. So when you see a cost of equity, if they're asking you to calculate cost of equity, first decide, is it DVM, is it CAPM? If it's CAPM, it will be very clear because the risk-free rate will be given. If it is DVM, the next thing you have to decide is it going to be, are we calculating growth using the extrapolating method or the Gordon's growth method? If it is Gordon's growth, then you will have something to do with the retention rate or the payout rate. And there will be some return on equity or an ARR or a ROC, some profit percentage will be there. Okay, so only then you can get G multiplying the multiplying the retention rate and that profit. Okay, so then you get G and you can put in the figures in the normal DVM equation. So the answer will be B here. Then it says Mile Company is looking to change its working capital policy to match the rest of the industry. The following results are expected for the coming year. We have revenue, cost of sales, gross profit. Revenue and cost of sales can be assumed to be spread evenly throughout the year. Working capital ratios compared to the industry are as follows. We have the receivable days, inventory days, payable days for Mile and the industry. Assume there are 365 days in each year. If Mile Company matches its working capital cycle with the industry, what will be the decrease in its net working capital? Okay. So first, you have to calculate its current working capital. Okay. Then you have to calculate the new working capital, new net working capital, and the difference will be the decrease in its net working capital. So let's quickly do this. It will take time, but it's very simple, right? So current net working capital, how do we calculate that? So you should understand that working capital means you have to have the receivables, the payables, and the inventory figures. Okay. So how do you get receivables, payables, and inventory? Using the receivable days, inventory days, and payable days. Okay. So I'll just give only for receivables, I'll put the equation. Receivable days equals to no. Yeah, receivable days equals to the receivables divided by the sales, okay, into 365. Everybody knows this. Into 365. So now we have the receivable days for Mile Company, which is 50. That should equal to the receivables is what we want. Divided by the sales, we know is 20,500. And I'll just put it like this. 20,500. Okay, I hope you understand what this is, right? I don't want to waste time with it. So I'll just do this. Receivables over 2,500 into 365. Okay. So you can rearrange the equation. I'm sure you're good at that already. So that will be 50 into 20,500 divided by 365. So you will get the receivables as 2,808. Okay. So likewise, you can get the payables and the inventory as well using the respective equations. Okay. So just like how receivable days has an equation, payable has, inventory days also has. So payables is payables over the purchases or the cost of sales into 365. Inventory will be inventory over the cost of sales into 365. Okay. So like how you did for receivables, you have to rearrange it and you will get answers like this, 1,403. And for inventory, it will be 1,578. Okay. Then you get the net working capital. So that will be equal to the receivables plus the inventory minus the payables. So that is 2,983. So this is current. You should get another figure for new as well. So I'll just give you the figures. New net working capital. So how do you calculate the new one? Basically, same equations, but this time you will use the industry figures, 42, 35, and 35. So when you put the industry days into the different calculations, you will get 2,359, 1,227, and inventory also will be 1,227. Okay, so net working capital is going to be receivables plus inventory, okay, minus this. So it will be the same as receivables, 2,359. So the net decrease in working capital is this figure minus this figure, which is 624. So 624,000, actually 600. Okay, so it will be A. Since we, rounded off all the figures, we get it as 624, but this is enough for us to get the answer. It is close to 624, so just tick off A. Okay, because we don't want to waste too much time. Right. Then we come to the 12th one. Are the following statements true or false? A prospective merger would need to result in a company having a market share greater than 80% before it can be described as a monopoly. Monopoly means what? One company is dominating the industry. Okay. So, but we can't definitely say that it has to be more than 80%. Only then a prospective merger will result in a monopoly. Okay, because maybe sometimes it may be less than that, but depending on the market share of the current company who is doing the takeover, the percentages will change. Okay, so we can't say hard and fast that only if the the market share is going to be more than 80% in the company you're going to acquire, you will get monopoly. Okay, so maybe for example, you already have 70%. You already have 70%. So then even if you acquire a company with only 10%, you'll still have monopoly. Okay, so that is false. A government may intervene to weaken its currency exchange rate in order to eliminate a balance of payment deficit. Okay, so balance of payment deficit means your imports are greater than your exports. Okay, so if we weaken our currency's exchange rate, then think about it. Imports, it's going to become, let me put it the other way around, the export will become more feasible. Okay, because the country's currency is weak. No, so if you export it to a foreign country, then the amount that they send, let's say they send in dollars, when you convert it, you will get more rupees. Okay, so if we have a balance of payment deficit, okay, I'll just type this. If we have a balance of payment deficit, we mean that import is high. So we want to reduce the import or we want to increase the export. So if you want to increase your export, then one way is to weaken your currency, because if you weaken it, it will become more lucrative, right? Because if somebody exports it, they will get money in another foreign currency. When they convert it to our currency, they get a lot of cash. So weakening the currency, but if you have a balance of payment deficit, is actually true. Because by weakening the currency, you will demotivate people from importing and you will motivate people to export. So that's true. A relatively high rate of inflation will lead to a strengthening currency. That is obviously false. If the inflation is high, then the currency will actually weaken. Government fiscal policy involves the management of interest rates. Wrong. That is the monetary policy. Fiscal policy involves taxation and public spending. Okay. Right. Which of the following statements about interest rate risk hedging is correct or incorrect? An interest rate floor can be used to hedge an expected increase in interest rate. Floor means we are going to set a minimum rate. Okay. So if the interest rate is going to increase, then the floor is not really going to help you, right? You need a cap. Only a cap means we will make sure that the interest rate doesn't go beyond that. Floor means it's a lowest possible minimum interest rate. Even if the interest rate increases slightly, it's going to be definitely more than the floor. So the first one is incorrect. The cost of an interest rate floor is higher than the cost of an interest rate collar. That's true. Okay, because collar means you get only a range of interest rates, whereas floor is fixed. Okay, so that is of course true. Just have to know that. Okay. The premium on an interest rate option is payable when it is exercised. Incorrect. Premium on an option, you have to pay it upfront. Whether you exercise it or not, that premium has to be paid. The standardized nature of interest rate futures means that over and under hedging can be avoided. That's wrong. Okay, because it is standard. That means, for example, if it is 62,500 blocks interest rate, I mean, I'm talking about Forex, but even interest rate, the futures are standard. That means anyway, there will be over or under hedging, because the amount that you want to hedge that has to match with the standardized amount, which is very unlikely to happen. Okay, so definitely under hedging, over hedging is there when it comes to futures. That's incorrect. 14th one, which of the following statements is true? Value for money is usually taken to mean economy, efficiency, and engagement. Wrong. Economy, efficiency, and effectiveness. Cum dividend means the buyer of the share is not entitled to receive the dividend shortly to be paid. That's wrong. Cumulative dividend means they are entitled for the dividend as well, including cumulative of dividend. Ex-div means excluding dividend. They can't get the dividend. The dividend payout ratio compares the dividend per share with the market price per share. No. The dividend payout ratio, no, it's not DPS over MPS. Okay, so that is wrong. The agency problem means that shareholder wealth is not being maximized. That is true. Why? Because the directors or the managers, they are trying to get their benefit. They are trying to benefit personally at the expense of the shareholder. Right. The last one in the MCQ section. Swap company is due to receive goods costing 2,500. The terms of trade state that payment must be received within 3 months. However, a 1.5% discount is given for a payment within 1 month. Which of the following is the annual percentage cost of ignoring the discount and paying in 3 months? Okay. How do you think you can go about this question? By the way, guys, this particular style of question, it came up even in the pre-mock. Okay, so there is a technical article called interest rates, if I'm not mistaken. Please have a read at that. Okay, because calculating this annual percentage, there are different methods. They explain it clearly in the technical article. Okay, and since this question popped up in the pre-mock as well, I'm telling you, just have a look just at that technical article. Okay, right. So to do this, you have to first figure out what is the discount we are talking about. So we are talking about a 1.5% discount. So 1.5% into 2,500. So that is a $37.5 discount. Okay. Now, if you take the discount, then the amount that you're going to pay is how much? 2,500 minus this figure, which is 2,462.5. Okay. So the discount as a percentage of how much you are paying is this 37.5 divided by 2,462.5. Okay. So let's take it as a percentage. We are talking about how many percent? 2% will take few more. 1.5228%. Okay. So if you take this 1.5% discount, you're talking about actually a 1.5228% discount. But you get this only, what is the actual payment period? 3 months. But you will get it if you pay in 1 month. So 3 minus 1, this is a discount for a period of 2 months. Okay. It's a discount for a period of 2 months. Now, in this interest rate technical articles, they say that if you want to get the annual percentage, you can just take 1.528. This is a 2-month figure now, so divide it by 2 and multiply it by 12. So that will give you the annual rate. For 12 months, it will be 9.14. That's what they're saying in the technical article. But unfortunately, that answer is not there here. Okay, that's because, like I said, there are different methods to do this. Another method, if you can remember, is this EAR, effective annual rate. You might have learned this in MA, where we say the EAR equals 1 plus the rate, monthly rate, okay, to the power n. Okay, to the power n is the number of this. It will look like this. 1 plus the rate we are talking about is 1.5228%. To the power n means we are talking about basically how many periods. If you're talking about 2 months, okay, then the number of times you have to do that 2 months in a year, 2, 4, 6, 8, 10, 12. So you have to have that 2 months 6 times, only then you will get 12 months. So that will be to the power 6, sorry, to the power 6 minus 1. Okay. That will be 1 plus 1.5228% to the power 6 minus 1, because 1.5228 is for 2 months. So the number of periods that you will have to multiply this is actually 6. If you multiply 2 by 6 only, you will get 12 months. So the effective annual rate will end up being 9.49%. That answer you have as D. Okay. So maybe like, honestly, I don't know why both are giving different answers. It could be because at that period, they were only asking for EAR to be used. Okay, but like I said, this is 2016. So if you use this equation, definitely you get the answer. But after that, a technical article that was written, they even allowed this method. And even in the pre-mock, when they are explaining in the debrief videos, they allow this method. Okay, but anyway, for us to be on the safe side, no both. Okay, so if you do one and you don't see that answer in the MCQ, then use the other one and see if it works. You have two ways not to do it. So that's that. So yeah, make it a point to read that interest rate technical article. Okay. Okay, so I think we will have time. We'll see. Now this is kind of like an MTQ. This is to do with risk management. Let's do it because we didn't talk about it much today. Hold on, because I'll take another risk management question, okay? Because there was a small issue with this one. Just give me a second. Revision. This is why it's, if you have a revision kit, they will, make sure that everything is properly updated, right? But the problem with the revision kit is you don't get a mix of questions. Okay, that's the only issue. All right, so let's try this one out. Let me just check 1 second. Yeah, herd company. So I'll give you a second. You can read it. And then I will also go through it quickly. Okay, so the first one you should be familiar with. Okay. It says herd company is based in a country whose currency is the dollar. The company expects to receive 1.5 euros in 6 months' time from find company, a foreign customer. The finance director of herd company is concerned that the euro may depreciate against the dollar before the foreign customer makes the payment, and she is looking at hedging that receipt. Then they're saying herd company has in issue loan notes with a total nominal value of 4 million, which can be redeemed in 10 years' time. The interest paid on the loan notes is at a variable rate linked to the LIBOR. LIBOR is the London interest rate, interbank interest rate, okay? So if you have a variable rate, usually it will be linked to this LIBOR. The finance director of herd believes that interest rates may increase in the near future. The spot exchange rate is that the domestic short-term interest rate is 2, while the foreign short-term interest rate is 5. Okay. Then it's saying per year. What is the 6-month forward exchange rate predicted by the interest rate parity theory to 2 decimal places? So we did this a little earlier. The forward rate is the rate times 1 plus the interest rate of the counter currency divided by 1 plus the interest rate of the base currency of 3. Okay, 1.543. That you multiply it with, remember, the base is the dollar. Okay, so the counter currency means they are talking about, okay, they are telling that it is foreign, so it is 5%. But that is for 1 year, we need only for 6 months. So 1 plus 5% into 6 over 12 will give you 2.5%, half, okay? Divided by 1 plus the interest rate of this currency, domestic short-term interest rate is 2. So half of 2 is 1. So we are talking about 1.566. Okay, 1.566. Then the 17th is saying, as regards to the euro receipt, this 1.5 million euros, what is the primary nature of the risk faced by herd company? So what is the risk? Today, I mean, in 6 months' time, we are going to receive the 1.5 euros. We are scared that our currency will depreciate against the dollar. Okay, so that is the problem. So this is actually a transaction risk. So that will be A. Which of the following will not be suitable for hedging the euro receipt? We can go for a forward exchange. We can go for a money market. We can go for a currency future, but we can't go for a swap. Okay, why? A swap means one company is paying a fixed rate interest, another is paying a floating rate. They swap. Okay, the one who is paying fixed, they pay floating, and the floating person pays fixed. This has nothing to do with hedging a receipt. Okay, that is if it is an interest. Even if it's a forex swap, we are talking about one in one currency. Somebody has taken a loan or something in one currency, another person has taken in another currency. We are trying to swap it. Okay, so that will anyway not really hedge the 1.5 receipt in euros. So you have to either go for a forward, a money market hedge, or a future. Which of the following statements support the finance director's belief that the euro will depreciate against the dollar? Okay. So he's saying that the euro will depreciate against the dollar means dollar becomes stronger. So it's saying the dollar inflation rate is greater than the euro inflation rate. Okay. So what is he saying again? He's saying that euro will depreciate. That means the inflation in the euro country, that will only be higher. If a currency is depreciating, inflation in that country is high. So him saying that the dollar is greater than euro is wrong. In fact, the dollar inflation should be lesser than the euro inflation. So the first one is it does not support the director's belief. Then it's saying that the dollar nominal interest rate is less than the euro nominal interest rate. Okay. So again, if you are in the country where your currency is strengthening, then your interest rates are usually low. Okay. So now here the dollar is only strengthening. That's what the director believes. So if the dollar is strengthening, then the nominal interest rate should be lesser than the counter currency, which is what the second point is saying. Okay, so that is only purchasing power parity and interest rate parity. Purchasing power parity says if you are strengthening, inflation in your country is low and interest in your country is also low. Whereas if your currency is weakening, then inflation in your country is high and interest in your country is also high. Okay, so the second one supports the director's belief. Okay. Then the 20th one, as regards the interest rate risk faced by herd, which of the following is correct? Okay, so what is the interest rate risk they're facing? They are issuing loan notes, which is redeemable, and the interest paid is variable. Okay. So it's a loan note, right? Okay. In exchange for a premium, herd company could hedge its interest rate risk by buying interest rate options. Okay. If you have an interest rate option, definitely you have to pay a premium. So interest rate risk means obviously the rate is going to fluctuate. So if you have an option, that means you can fix, basically, this is a receipt or a payment. Yeah, we are going to actually pay interest now. So we can fix the maximum interest rate. Okay, we can fix the maximum interest rate. If the market rate goes more than that, then we will exercise our option. So actually, that is correct. Okay. Buying a flow will give herd company a hedge against interest rate increases. It doesn't. A flow will only give you a hedge against interest rate decreases, not increases. Herd company can hedge its interest rate risk by buying interest rate futures now in order to sell them in the future date. Okay. So when you talk about interest rate futures, you have to remember this it's a rule that you have to remember. If you are going to borrow, if you're a borrower, you have to sell first and buy later. If you're a depositor, you have to buy first and sell later. Learn it as a rule. Okay, when you do AFM, you will understand why this is the case. For now, learn it as a rule. So now here, we are a borrower because we are issuing loan notes and somebody is giving us money, we are borrowing. So if that is the case, we have to sell futures now and buy back later. Whereas here they're telling us to buy interest rate future now and sell it later. So this is the opposite. This you would do only if you're a depositor. Okay, so since we are a borrower, we have to sell and buy later. Sell now and buy later, so it can't be C. Taking out a variable overdraft will allow herd company to hedge the interest rate risk through matching. Okay. So if you take a overdraft, you will have another loan. Okay. So you will have another loan. Already you have taken another loan. Okay. What do you call the issue of bonds, is it? Yeah. Loan notes. Sorry. The loan notes, that is also kind of a loan. It's a borrowing. So if you have to match it, then you have to deposit somewhere. But here they are asking you to take another overdraft, which is another loan. So it's not going to match. If you want to match, then you have to deposit somewhere and make sure that you get an interest. And the interest that you get and the interest that you're paying, it matches. So here, taking one loan to match with another loan doesn't make sense. So D is wrong. Okay? D is wrong. Definitely wrong. So the answer there will be A. Sorry. Yeah, so it's A. Okay. We have two questions. I think we will have time for one. So let me choose let's do the second one. And then if we have time, let's do the other one as well. Let's do link company. Okay. Link company has been prevented by the competition authorities from buying a competitor, Twist company, on the basis that it prevents a monopoly position arising. Okay, so in a government, if they want to not have monopolies, they can actually impose these kind of competition authorities and stop people from buying other businesses if a monopoly can arise. They have therefore decided to expand existing business operations instead. And as a result, the finance director has prepared the following evaluation of a proposed investment project. So we have present values of sales, variable cost, contribution, fixed cost, and operating cash flow. The initial investment is 1,800 million and the net present value is 511 million. Project life is expected to be 4 years and the finance director has used a discount rate of 10% in the evaluation. Investment has no scrap value also. Then it's saying the finance director is considering financing the investment project by a new issue of debt. 26 is asking you, what is the change in sales volume which will make the NPV 0? So what are we talking about? We are talking about sensitivity analysis. How do we calculate sensitivity analysis? It is a very simple equation, right? We take, now if you want to know what is the change in sales volume, then there is another figure. But a more common one, like for example, if you want to know what is the change in sales volume, which will make, what is the change in sales revenue, which will make NPV 0, then how we calculate that is, you take the NPV and you divide that by the present value of sales revenue multiplied by 100. That is the sensitivity. Now, if you want to know what is the change in variable cost, which will make NPV 0, again take the NPV divided by variable cost into 100. Okay. So here they are asking you for what is the change in sales volume. So usually this change in sales volume, how we get it is you take the NPV, you divide it by contribution. Okay, so you have to know this because this is the only one where it is not so straightforward. Okay, so NPV divided by contribution into 100. So NPV is how much? 511 divided by contribution, which is present value of contribution 3,880. So again, this is present value, okay? Present value of contribution, which is that. So as a percentage, we are talking about 13%. They are giving it to one decimal place. So let's also give it to 13.2%. So that is B. Okay, B. So always remember, sensitivity analysis is the NPV divided by the present value of whatever variable they are asking. So if they are sales revenue, present value of sales revenue. Variable cost means present value of variable cost. Fixed cost means present value of fixed cost. Okay. Initial investment means NPV over initial investment. The only time when it won't be very clear is sales volume. In that case, you have to take NPV over present value of the contribution. Right. 27. Which of the following statements relating to sensitivity analysis is correct? 1. Although critical factors may be identified, management of link may have no control over them. That is true. We might say that, okay, sales volume is critical, meaning if it changes slightly also NPV is becoming 0. Still, we can't really, I mean, maybe sales volume, maybe we can control, but something like a fixed cost, we can't really control it. Okay, so 1 is correct. A weakness of sensitivity analysis is that it ignores interdependency of project variables. That is true. When we are calculating the sensitivity, we assume that other than contribution, everything else remains constant. Whereas that may not be true. In one situation, sales revenue can change, variable cost will change, fixed cost also can change. Then in that situation, you can't use sensitivity analysis. You have to use another model called the simulation. Okay, simulation. Again, you don't have to know how to do the calculations. Sensitivity analysis can be used by Link to assess the risk of an investment project. Sensitivity analysis is not to assess risk, it's to assess uncertainty. Okay, so you should know that the answer is 1 and 2. Which of the following methods is correct? The return on capital employed, ROCE, considers the time value of money. Okay, let's think about it. Then it says the return on capital employed must be greater than the cost of equity if a project is to be accepted. That is, of course, kind of, wait a minute, return on capital employed must be greater than cost of equity. Sorry, it has to be greater than the cost of capital. Okay, not just the cost of equity. So that is not correct. Riskier projects should be evaluated with longer payback periods. That seems to be correct. If it's riskier, it's better to evaluate with longer periods. So then, we are taking more time. Payback ignores the timing of cash flows within the payback period. Actually, that's true. Okay, that's very straightforward. And it is true. And the first one, ROCE, we don't consider time value of money because it is not a cash flow based method. First of all, it's a profit based method. So the correct answer is D. Payback ignores the timing of cash flows within the payback period. We don't discount anything. But then again, if you are using discounted payback, then we will consider the time value of money as well as the timing of the cash flows within that period. Okay. I'm sorry, we will consider the time value of money. But again, even discounted payback, we will not consider the timing of the cash flows. When in the year did you get that 250,000? We don't care. We just assume that everything happens at the end of the year. Okay. Which of the following statements relating to debt finance is correct? Link can issue long-term debt in euro currency markets. Euro currency, I told you, was a type of money market. Money markets always short-term. Okay. The interest rate which Link pays on its new issue of debt will depend on its weighted average cost of capital. That's wrong. The weighted average cost of capital only will depend on the interest rate, not the interest rate being dependent on the weighted average cost of capital. So B is wrong. A new issue of loan notes will take place in the primary market. That's true. If it's new, it will happen in the primary market. If it is, if it is a traded instrument or a second-hand issue, basically, then it will happen in the secondary market. Okay, so if it's a new issue, in the primary market, if somebody who has already bought it wants to sell it, then it will go in the secondary market. Link company will not be able to issue new debt without offering non-current assets as security. That's not true. Not all bank loans, not all debts require security. Especially now, if it is something like a loan note or a bond, chances are that you won't have security. Okay, so that is not correct. So the answer is C. Which of the following statements to competition policy is correct? Scale economies are an advantage of monopoly and oligopoly. So monopoly, oligopoly means you are going to have most of the business for your particular, your particular company. So then what will happen? Obviously, you will have economies of scale because the number of goods that you are producing will be pretty high. So as a result, the cost per unit will drop. So one is correct. Social costs or externalities are an example of economic inefficiency arising from market failure. So what is social cost or externality? It means for something that the company is doing, the company is not bearing the cost. Somebody else is bearing it. For example, they may be polluting the environment. They are not bearing that cost. It's the public who is bearing that. They are the ones who have to deal with the pollution. Okay. So that is an example of economic inefficiency. It is a market failure. That is correct too. Monopoly is discouraged because it can lead to inefficiency and excessive profits. Correct. Third one is definitely correct. So the answers are 1, 2, and 3. Question 22. 1 second. Okay. There was one more question. I think there is only one more person other than so I'll take time and go through this as well. Okay, anyways, we have 4 more minutes now, so no problem. Right, so let's go through the last question for this TRG. I know that I am trying to fit in a lot of questions, but at this point, to be honest, I hope and pray that all of you are in a position where you can absorb all of this. Okay, because it's only 10 days to the exam. So definitely my speed should match, it should sync with your understanding capacity. Okay. So it says here, the finance director of Coral Company has been asked to provide values for the company's equity and loan notes. Okay, we are asking for values for company's equity and loan notes, market values probably. Coral is a listed company and has the following long-term finance. So we have ordinary shares, book value 7.8 million, 7% convertible loan notes, book value 8 million. The total value is 15.8. The ordinary shares of Coral have a nominal value of 0.25 per share and are currently trading on an ex-div basis at 7.1 per share. So we have the market value. An economic recovery has been forecast, and so share prices are expected to grow by 8% per year for the foreseeable future. The loan notes, they are saying, are redeemable after 6 years at their nominal value of 100 per loan note, or can be converted after 6 years into 10 ordinary shares of Coral per loan note. The loan notes are traded on the capital market. The before tax cost of debt is 5%, and the company pays corp tax of 20% per year. So first question they're asking you, what is the equity market value of each loan note of Coral Company, right? Sorry. What is the equity market value of Coral Company? What is the equity market value of Coral Company? Now here, it's kind of straightforward because we have the market value and we can find out the number of shares in issue as well. 7.8 divided by 0.25 is the number of shares in issue. So if we take 7.10 and multiply it with that answer, you will get the market value. So let's quickly do that. So number of shares in issue, we are talking about 7.8. That's the total book value divided by 0.25. That is 31.2. Okay, 31.2 million shares in issue. If we want to know the market value, then that is simply 7.10 into 31.2. Okay, so I'll just put it over here. 7.1 into this. So the market value is 221.52. Then the next one is asking you, assuming conversion, what is the market value of each loan note in Coral Company? Okay, so what is the market value of each loan note in Coral Company? Okay. Right. So how this will work is, we need to find out basically, are we going to go for a conversion or are we going to go for a redemption? Because the redemption is going to happen at $100 per loan note. Okay. So let's calculate first of all the conversion value. So for conversion, 6 years, after 6 years, you can get 10 ordinary shares. So first let's find out what's the market value of a share in 6 years time. Okay, what's the market value of a share in 6 years time? How much will it be? Currently it is 7.10. It will grow at 8%. So 100 plus 8 is 1.08. We want to know for 6 years to the power 6. Okay. So in 6 years time, it will be 11.26. Okay, 11.26. So this, I'll just take it to 2 decimal places. 11.27 basically. So if we convert, okay, then what will happen? We will get 10 shares. So each share will be worth how much? 11.267. So ultimately, the amount that we will get in hand is going to be this figure multiplied by 10. So 112.67, that is the conversion value. That's the conversion value. Now, the redemption value is 100. So obviously, we will go for the higher option, which is 112.67. In your exam, please make it a point to write that. Okay. Since the conversion option is greater than redemption, the loan notes, right? Yeah, loan note holders will opt for conversion. Okay. So now you have to just do basically like a IRR style calculation for you to get the market value of the loan note. Okay. So how you do that is take the years. Okay. Take the years. Then you will have the interest that we have to consider. So that is year 1, year 2, year 3, year 4, year 5, and year 6. Okay. Sorry, not an IRR, right? I'm sorry. They're asking for market value, no? So you don't need an IRR. I mean, it will be an IRR style calculation, but you don't have to take 2 discount rates and things like that. I'll show you how it's done quickly. Because if it's the cost of debt, then you need IRR. This is market value. Okay. So years means year 1 to year 6. Year 1 to 6, you will have the interest. And in year 6, you will have the conversion. Okay. Then we will have to consider the discount factor. Okay, I got your question. Why you're using the before tax rate and not the after tax rate? Okay, so the thing is here, when you're talking about market value, did you calculate using post tax? Did you calculate using post tax? And what was the answer you got for market value when you did that? 118. Close, right? It's like this. When it comes to the redeemable debt, it's very simple. Even if you're taking cost of debt, think about it. It is an IRR calculation. So IRR means you can use basically any two figures that you want, right? Whatever it is, and the IRR, that KD, it can fluctuate. Okay, so it can be 5, it can be 5.56, because IRR, it will change depending on the discount rates that you used. If you used 1 and 20, it will be some other IRR. If you use 5 and 6, it will be another IRR. Okay, so in this kind of a situation, either way, it shouldn't be much of a problem. If it came in a constructed response and you gave 118, they will completely mark that fine. But here, you can see that 118, it's closest to this 119.58. Okay, so in that case, you have to use your rational, you should be rational and choose C. Okay, the reason I'm telling you, because when it comes to this redeemable debt, it is all an estimate. Okay, so sometimes you might use the before tax cost, because in this case, it's easier, right? If you go and use the after tax cost units, then you have to start taking different interest rates. Okay, so to make things easier, they have just used the before tax cost and taken here 7 as the interest rate. And over here, the conversion rate is 112.67. Okay, but anyway, even if you take 5 times 1 minus t, it's not wrong. Definitely, it's not wrong. And here, if you take 7 times 1 minus 20, again, it's not wrong. Okay, it's because anyway, this market value is an estimate. You can't expect it to be correct for all the values that you're taking. Okay, so if it is a constructed response, don't worry. Anyway, you'll get the full marks. If it is an MTQ, then just choose the closest answer, because you know that your technique is correct. Yeah, you know that what you are doing is correct. This is happening because of the estimate difference. Okay. Right. So at 5%, annuity factor for 6 years is 5.076. Okay. And year 6 discount factor will be 0.746. So then you can get the present values quickly. That is this 7, into this. Drag it down. Okay, and then you can get a total. This plus this. Okay, so that is 119.58. The market value will be C. Okay. Right. So I'll just go through the last 3 as well. Which of the following statements about the equity market value of Coral Company is or are true? But again, Yunus, if you're using the pre-tax here, make sure this is also pre-tax. 7. You're not using 7 times 1 minus t. Then it's a mismatch. If you're using 7 times 1 minus t, then use the 5 times 1 minus t as well. Okay, so get that clear. But both ways will definitely work. Which of the following statements about the equity market value of Coral Company is true? The equity market value will change frequently due to capital market forces. That's true. Market values, they go up and down in the share market. So that's true. If the capital market is semi-strong form efficient, the equity market value will not be affected by the release to the public of insider information. That's wrong. Because if you're semi-strong form, then the share price in the market, it will reflect all public information. Okay, but if there is private information, insider information, then definitely the equity market value will be affected, because it won't reflect the insider information. Okay, so second is wrong. Over time, equity of market value of Coral will follow random walk. That's also true. So the answers are 1 and 3. 24th, indicate whether the following assumptions made by the dividend growth module is true or false. Investors make rational decisions. Yes, that is an assumption we make in the dividend growth model. Dividends show either constant growth or zero growth. True. It's either 8% or 0%. In the DVM equation, we assume that the growth is constant or there is no growth. We can't think of a situation where in 1 year the growth is 2%, another year it is 4%. We can't think of a situation like that, okay, because we are assuming constant growth. So that is also true. then the dividend growth rate is less than the cost of equity. That is true. Okay, because look at this equation. I think I had it here somewhere. I'm sorry for taking a little more of your time since it's the last class. Okay. Now see here, if the growth rate was actually more than the cost of equity, think about it, the denominator will become a negative figure. And you should know mathematically, if you take a positive numerator divided by a negative denominator, it will say math error. Yeah, it will say math error in your calc. So you can't divide something with a negative figure. So we assume that the growth rate is always less than the cost of equity. So that is also a yes. So all three are assumptions. The last one, why might valuations of the equity and loan notes be necessary? Why should you value equity and loan notes? One, the company is planning to go to the market for additional finance. So then, yeah, if you're going to go to the market for additional finance, they will definitely ask you what is your market price per share. For that, definitely you have to have a market value for equity. The securities need to be valued for corporation tax purposes. For tax purposes, we only need to calculate taxable cash flow. We don't need to have values of our equity and debt and stuff. We just need sales minus the variable cost, minus the fixed cost, minus any tax. Yeah, I mean, minus the fixed cost, you will get a taxable cash flow. On that, you calculate 20% or whatever taxation, that is the tax rate. So we don't need any valuation or, valuation for equity or loan notes or anything when it comes to corporation tax purposes. It's completely out of the syllabus, not the syllabus, completely out of the books when it comes to taxation. So 2 is not correct. The company has received a takeover bid from a rival company. That case, they should know what is the market value of their equity. Yeah, only if they know what their market value is, will they realize, okay, is this a good bid? Are they giving us a good price? Only then you will know if the rival is giving you a good price and whether you should take it or not. So for 3 also you need valuation. So 1 and 3. Okay. Right. So that's all for this TRG. I wish you all the very best for your exams, which is going to be on the 8th of March. Again, I'm repeating, please do the pre-mock, go through the debrief video, time yourself and mark it. It is very important. If you are done with all of this, finally, be confident. We have done work for 1 month. That's, I'm telling you, more than enough for any world prize. 1 month is the time. I have a world prize for AFM. I started learning 1 month before. So if you also did the same from February onwards, you've been doing some work. This is FM, much less complicated than AFM. Definitely you have all that it takes to pass this paper with flying colors. Besides, you have another 10 days to go. Even if it means that you have forgotten everything that you did, you have enough time to revive whatever you learned. Okay. So at this point, you still have time to do your entire revision kit again, mark it again, go through it again, memorize whatever you need again. Okay. So there is enough time. I'm not leaving you at a point where we have only about 2 days to the exam. I'm giving you 10 days. I have spoken about all the important topics of this syllabus. You name it, everything I have spoken about. So feel free to go through the TRGs. Everything is available, even on YouTube, it's available. So if you're having a problem with the LMS, then you can always access on YouTube. So first thing I'm telling you guys, be confident. Okay, because confidence is key. You have done your work. You deserve this paper. You deserve the mark that you're going to get. Okay, so know that no paper 100% will be based on previous questions. Sometimes you will see 1 or 2 questions you have never seen before, although you did your practice. Don't get demotivated just for that. Okay, every paper that will be the case. If you want to reduce the number of questions that you have never seen before, there is only one tried and tested method, and that is for you to finish the revision kit multiple times. 2 times, 3 times, any number of times. If you can finish it again and again, that will definitely help. Okay. Right. So that's all I have for this TRG. I hope it benefited you guys. Those of you who are currently here, plus those of you who are seeing this on places like YouTube. Again, like I said, FM, one of the best syllabuses, one of the most enjoyable subjects. I hope, you have what it takes to do AFM. It will definitely be your career will take a very interesting turn. Okay, so having said that, all the best once again. I'm sure you guys will rock this exam. All right. Okay, so hope I will see you maybe at an AFM lecture sometime in the future. That's it from me. Have a good night, guys.